Group Statements, Chapter 7, Examples 7.4 and 7.5. Example 7.5 looks at the scenario where there is the revaluation of a non-depreciable asset, so we're still working with land, where the partially owned subsidiary recognizes the revaluation in its own records at a date other than acquisition date. It is based on the same example as in 7.4, but we're now adding the effect of non-controlling interests. B Limited acquired an 80% interest in the net assets of S Limited on 1 January 20X9. On this acquisition date, the trial balances of each of the companies reflected the following balances. I have property, plant and equipment being land in the subsidiary measured at 100,000 Rand. The investment in the subsidiary in the books of the parent is measured at 120,000 Rand. Share capital and retained earnings at acquisition date is further provided in the TB of the subsidiary. On 1 January 20X9 being my acquisition date, the identifiable assets and liabilities of S Limited were considered to be fairly valued, except for the land that was undervalued with 20,000 Rand. So the 100,000 Rand on the trial balance of S is undervalued with this 20,000 Rand. It is the accounting policy of S Limited to account for land in terms of the revaluation model. The subsidiary, however, decided not to account for this revaluation at acquisition date in its separate financial statements. So it's a very similar example than we had in example 7.3. The subsidiary did revalue this land for the first time on 1 January 20X10, which is 1 year after acquisition date. But now it was revalued downwards with a deficit of 35,000 Rand. This was the only movement in the land's carrying amount during 20X9 and 20X10 in the separate financial statements of S. On 31st December 20X10, the trial balance of each of the companies reflected the following balances. The land is now measured in the separate TB of the subsidiary at 65,000 Rand, which is the 100,000 Rand cost price minus the deficit recognized during 20X10 of 35,000 Rand. Please note the way the information is given on the trial balance. Profit for the year is given as 110,000 Rand, but then the revaluation deficit through profit or loss for the year is just listed as a separate line item for information purposes. Typically, that profit or loss would be included in profit for the year. It has only not been closed off to profit for the year in this trial balance yet. The suggested work method will now help us to identify any differences that would result in consolidation journal entries. My starting point is the trial balance of the subsidiary, which indicates that during the current reporting period, the subsidiary recognized a revaluation deficit through profit and loss to revalue this asset to the fair value of 65,000 Rand. The moment the subsidiary revalued the asset since acquisition date, that is also the correct value of the asset for group statement purposes, and no further differences will be applicable. But because the subsidiary didn't value adjust at acquisition date for the 20,000 Rand, the carrying amount of this land is 120,000 Rand in group statement purposes. If the revaluation deficit coming from the trial balance of the subsidiary is left as is, the land will be measured in the group at 85,000 Rand, being the 120,000 adjusted carrying amount minus the revaluation deficit of 35,000 Rand. But because the 65,000 Rand is the correct fair value of this land, the revaluation deficit that should be recognized in the group must be 55,000. So if my starting point has a revaluation deficit of 35,000 Rand, I need to change that only with 20,000 Rand to have my allowed 55,000 Rand revaluation deficit recognized in the group. The consolidation journal entries that would now be necessary for these differences identified are as follows. On 31 December 20x10, which is my current reporting period, when I consolidate, I have to remember to create that revaluation surplus at. That's why it's so important to do this work method calculation from acquisition date. Then the question is, what do I debit? At the end of 20x10, the land of S is correctly measured at 65,000 Rand. I cannot change that value in the group. The debit entry goes to the line item in S that's different from what I wanted to be in the group, and that has been identified as the revaluation deficit through profit and loss. In the TB of S, it's 35,000 Rand. It should be 55,000 Rand in the group to make sure that the asset is still correctly valued. That 20,000 Rand debit is therefore recognized as a revaluation debit through profit and loss adjustment debit entry. This gives effect to that 20,000 Rand difference identified. If I have to prepare the consolidation journal entries for this scenario in 20x11 or any subsequent reporting period, the following would apply. I still create my credit to revaluation surplus at. If I do not create that surplus, I do not have it available to eliminate through the at acquisition consolidation journal entry. But in 20x11 and all subsequent years, the revaluation deficit of 35,000 Rand has now moved to the retained earnings opening balance of S, where all profit and loss items are closed off to. If I then have to identify the debit leg of this journal entry for the item in S that's different from what it should be in the group, the debit then goes to retained earnings opening balance of S. Please note when you study these journal entries, the journal entries change year after year depending on what has happened with the underlying asset. I do not write all these journal entries every single year. The only journal entry that I repeat every year is the credit to revaluation surplus at. In 20x9, the debit would have been to land. In 20x10, the debit is to revaluation deficit through profit and loss. In 20x11, the debit is to retained earnings opening balance. The debit changes depending on what has happened to the underlying asset.